Well, g'day there, traders and friends, market participants, and enthusiasts right around the world. Thanks a lot for joining me in this weekend's Pro Analysis class. Today's date is Saturday, the 27th of January 2018. This analysis is going to transition us through to another full week of trading, which will begin on Monday, the 29th. I hope you are, of course, enjoying yourself this weekend, no matter where you are located around the world. We are almost saying goodbye to the first month of 2018. It has come and gone essentially very, very quickly. I mean, I can remember back to the breakout which took place in the first or second day of January above 24,909. Here we are as at the close on Friday, printing up above 26,600. This market again continuing to move parabolic. And I guess the first half of this week's analysis is going to be on the actual status of the markets in terms of just how overbought and how overextended they are. I am going to show you, of course, the metrics of these overbought, I guess, oscillators that we can go back, I believe, to the 1960s, just to put this into perspective, because I do recognize and I do also understand that we haven't really had all that much trading action over the past 1 to 2 weeks. It has been a very quick start to 2018. We took advantage of that, but as we have continued back up into this retest of this decelerating fan line, which takes us back to the beginning of the bull market in 2009, it is, in my opinion, that we need to be very careful of a potential very quick, very sudden, very volatile snapback in the opposite direction. So I understand that we are still progressing through, of course, the earnings season. What is good to know is that Baidu, Caterpillar, Goldman Sachs, IBM, Netflix, and Tesla are all okay to trade. However, this week upcoming, it is going to be the end of earnings season for us. So let me just go through the stocks which is set to actually record their earnings as at the week. So we've got Apple and Amazon, also COP, which is set to release their earnings on Thursday. We have Boeing Airlines on Wednesday, and then on Friday we have CVX. Once we move and transition through this week, we have gone through all of our top 12 individual trade lists, potentially excluding Baidu, which generally is, or at least releases theirs a month or two later. So essentially after this week, we are back to normal trading, which is good. Again, this is a little bit of a blessing in my own personal opinion. The reason for that is because just at the extreme state of overboughtness across the board, starting with the S&P 500, but of course trickling also into the industrial average and the Nasdaq, it has left us with essentially our hands tied behind our backs. And again, there are a lot of learning opportunities to come from this. First of all, there is Apple. Apple is one that we were speaking about over the past number of weeks, and I was detailing just how immaculate the trade setup was. Now, we have seen Apple pull back, but just to put this in perspective, we had, I think, a conversation for maybe 2, if not 3 weeks leading up to this trigger essentially getting hit about how the trade, unfortunately, at that particular time, wasn't actually ready to be actually executed. The reason for that was earnings. So as I say, that the blessing of earnings season is correlating very nicely with the markets being as overextended as what they currently are. It has left us again in a little bit of a slowdown sort of predicament, but because of that, we have been very safe and playing this market a little less on the side of risk, but more so taking into the cautionary components of just what can happen. And I assume that is still going to be held true over the next week, if not 2 weeks, when we finally see a large outside day candlestick, preferably setting up on the industrial average more or less from these current levels. So it is going to be a very interesting week upcoming. I am going to, of course, continue with the discussion last week with the S&P 500. Again, going through some of the metrics that I first talked to you about maybe 1, if not 2 weeks ago in terms of the S&P 500 being the most overbought it has been in history, a recordable history. That is true, and also we are seeing similar metrics also on the industrial average and the Nasdaq after the continuous rally to the upside that we've seen over the past 5 days worth of trades. So just to give you a recap on the industrial average, you can see on my screen here we are left with another long day Morobozu candlestick. We closed up once again over 500 points. You can see in the top right hand corner of my screen, 545 points. You can see again we've got a shaved top, which again is essentially that of a shaved Morobozu candlestick. We do have a very, very, very minuscule lower wick here, but again, for all reasons considered, this is a very strong continuation signal. Now, personally, on the industrial average, I was looking for this market to slow down at 26,300. I also said that you have to allow a little bit of variance. The reason for that variance is because if we even go back on the monthly chart, and I mean, I'll just put this into perspective for you. I know it is absurdly ugly on my screen right now. There were horizontal lines and diagonal lines going everywhere, let alone all of these green past triggers that we've been in as the bull market has continued. But if you focus just for a second in 2009 and you make the very clear distinguishment that you have a low in the year 2010, we definitively broke that trend line at that time in 2011, and as such we've come on up on a number of occasions and almost tagged it, if not essentially tagging it. You have to understand that when we project this line into the future, really going back from really 2012 where we really last touched it, there has to be a little bit of leeway in terms of that resistance area, because when we project it out, you have to consider all of this white space, which of course is where price is running to up until the current juncture as at the close on Friday, where we are now only just closing above it. So again, we are not out of the woods, so to speak. We are still potentially right on the precipice of a major reversal, and it is still taking place with these oscillators which continue to move into just extreme overbought detail. Now again, as we move into the week, we do have a lot of stocks actually reporting their earnings. Again, just to run through, we've got Apple, Amazon, Boeing Airlines, COP, CVX, and Google. So it is going to be the farewell to the weeks or to this quarter's worth of earnings, which is fantastic. I'm very happy to say goodbye to this time of year. But as I bring up, of course, some of these metrics on the industrial average, you can see for yourself just as, I mean, just the reason why, or the reasoning for last week in particular being relatively that of a quiet week. When the markets essentially move into this parabolic sort of mania where really collectively they only know one decision, and when again fundamental sort of data continues to trickle out, which is adversely sort of, you know, good for the economy in and of itself, where I guess the fundamentals don't matter. It simply is another buy the dip opportunity. You have to recognize just how far we've come in terms of the market moving into extreme overbought territory. Now, if you pay attention to the RSI on my screen, you can see for yourself, this is the daily look of the RSI. Now, of the three markets and of the three different fractals that we look at on the daily, the weekly, and also the monthly time frame, you can say to yourself and make the argument that the RSI isn't that overextended. The reason why I'm using the RSI is because it is the fastest, it is the quickest to actually revert from these overbought settings. It is the first indicator when it comes to oscillators that is naturally going to reset. So what I may do for you in this exercise is actually remove that of the MACD and also that of the stochastic, so we can just simply pay attention to the RSI itself. Now, I understand the chart is going to be hard to interpret at this particular point. I wouldn't be paying attention to price action. What I want you to be doing, first of all, is to actually understand the relative strength index, the RSI. It is the first measurement, again, when we move above that 80 level, which is telling us that we are in extreme overbought territory. And what this means is that when we get above 80, an impending reversal, albeit on the minor level back into those exponential moving averages, is almost certain. Now, again, when we go up the different time frames, whether it's minor, which again is that of a lesser type of reversal, then we start obviously going into the weekly, which is the intermediate trend of the market itself. And then, of course, the largest macro look that we look at is the monthly chart. Now, again, on the daily time frame of the RSI, we're printing at 91.33, which if you go back to recordable history, we are back up at those relative highs that we've been at the, you know, in the past, or historically anyway. We haven't actually surpassed this on the daily time frame, but this is where it gets interesting. On this chart at the moment, going back to December 2011, we can say that more or less we are at, I guess, that furthest type of setting that we generally record on the RSI relative to that of the Dow Jones Industrial Average. It's very important that you understand this, because it's going to set the tone for how we interpret the market over the next 5 days, because I understand it can be a little bit frustrating if you see the market going up, say for instance the Dow, another 544 points on the weekly chart, however, not really understanding the amount of risk which is sort of being taken at this particular point by people who want to speculate on this market advancing higher. The RSI itself doesn't lie. It's a metric that traders use, all market participants, really any active market participant who uses technical analysis, a fantastic way to gauge the market in and of itself, to actually gauge whether it's overbought, oversold, or just sort of trending above that neutral 50 point to the upside. Everyone should pay attention to this. It is one of the best oscillating indicators in my own personal opinion, having traded the market full-time since 2011. But continuing on with this is where it becomes very interesting. Last week, of course, I was talking about the S&P 500, all right, because the S&P 500 in recordable history hadn't been as overbought as what it was as we moved into the week upcoming. Now, of course, these metrics have also moved into the industrial average and the NASDAQ itself. That's why I'm beginning with this speech on the industrial average, because I want you, again, to understand just what is at stake in terms of risk up and around these levels at 26,600. A lot of people are assuming that this is going to continue indefinitely. I myself find myself more so on the contrarian side of this, and really going back, or at least resorting to the laws essentially of gravity to say, no, it's not. We are pretty much as close to as far as we can possibly go. Historically speaking, I think as far back as 1960. Of course, these circumstances which we currently find ourselves in, the environment and the scenario, are of course different. But at the same time, if we are to continue higher, it is under my own personal opinion that we need to move through that of at least a slowdown, a consolidational channel slowdown, or even a pullback into those exponential moving averages until, of course, we can set up that next higher low and then continue with a little bit more safety, i.e. trades, moving into February 2018. But if we continue this discussion as well, pay attention to the RSI. This is on the weekly time frame. So we've gone out another fractal in terms of the market itself. Now, if you pay attention to this, of course, you can see that the RSI is printing at 95.17. If you go back in history looking at this RSI, ask yourself the question, even at the peak in the year 2000, and also at the peak in 2007, was the RSI as high as what we are currently registering? And the answer to that question is no, it's not. In fact, it was considerably lower to what we are currently printing on the RSI. Now, this is going back not only to 2012, like we were looking at on the daily time frame. Of course, this is the weekly time frame. This is going back to 1988. So again, we ask ourselves the question, if this market is as overbought as what it currently is, there hasn't been a time since 1988 where this market has been as not only short-term overbought, but also on the intermediate time frame when we're talking about larger fractals and also cycles within the economic and business cycle. Then we start going out into the largest fractal that gives us, I guess, workable information as technical chartists, and this is now the monthly time frame. I mean, we're going all the way back. I thought at the beginning of this recording, because I was actually, studying this back to 1960. In fact, this goes back, you can see for yourself, to the late 1800s. But as you can see, the markets have been, again, on a parabolic rise. The trend in and of itself, the macro trend, the macro trend is still up, which is great, and that's what we assume to be true with economics going forward. But at the same time, the RSI printing at 95.67. Have a look at the metrics of this. Pay attention to this horizontal line on my screen. We have come very close to this in the past, but we have not actually tagged the current overbought setting that we are printing at on the industrial average. Very concerning. I mean, this is going back essentially. Let me see if I can actually bring this up on my screen here. Pay attention to this number. It looks like the 31st of January, 1900. Okay? So we're going back 118 years essentially, and we haven't been this overbought on the Dow Jones Industrial Average relative to the RSI itself. Major warning signal, a cautionary signal. I wouldn't even call it a sort of an orange warning. This is flashing extreme red. And I want you to understand this again as we move into the week upcoming. It can be very hard, of course, to feel as though, or at least the FOMO, when it comes to trading the financial markets. The FOMO, of course, is the fear of missing out on what is currently going on. We have taken great advantage, not only at the beginning of 2018, but towards the end of 2017, with taking a majority of this bullish trend to the upside. But what you don't want to do in the world of analysis or even active trading is be late to the party or be one of the last few people into that of a parabolic move to the upside. Again, we have to allow these oscillators to reset. So if you ask yourself the question, if this is going on in the industrial average, you've seen it for yourself with your own eyes through the templates on my screen, pay attention to that of the S&P 500. Now, if I go to the daily chart again, this is where we started with, of course, the industrial average. You can see for yourself that the picture is a little bit different. If I bring up this horizontal line and show you where we're currently registering on the actual RSI, we are not below the all-time highs on the daily time frame. We're actually more or less above all of them on the daily time frame. Also, when we start going out onto larger levels, this is the weekly look of the S&P 500. I need to drag this horizontal line up a little bit higher. You can see we're printing at 94 or just above it again. This goes back to 1988. We haven't actually had one single period between 1988 and the current juncture as to how severely overbought this market currently is. Again, the RSI, and the reason why I'm paying attention to the RSI is because it is the quickest of the three oscillators. I cannot stress that enough. When it comes to the MACD, it shows momentum. It is slow. It takes a longer period of time for the signal line to cross the slow line, which generates the actual histogram, acceleration or deceleration away from that neutral line, okay? When it comes to the stochastics, it is a slower time frame as well to that of the RSI. And again, as we move out onto larger macro levels, when they start adjusting, or when the RSI actually turns down, a definitive turn down signal, that is the best warning signal that you have that the market or that individual stock is set to actually move into that of a retracement, okay? Whether it's a bearish retracement within a bullish trend, which is currently what's going on at the moment, or what I'm assuming is going to happen, or that of a bullish bounce within a bearish trend, which is really quite, I mean, it doesn't happen as commonly in that of a bear market. Generally, when you move into a bear market, it is very sudden, and you've heard the expression and the saying that the market takes the elevator down but the stairs up. However, over the past 3, 4, if not 6 months, the market itself has been, it's almost like it's inverse at the moment. The market itself is taking the elevator up, and generally when you see these reversals, the reversal happens faster than that of the parabolic move to the upside, which is a little bit scary considering just how, or at least the trend of velocity, the angle of ascent, to what is currently underway collectively and across the board with the US financial indices. Again, this is the weekly look of the S&P 500. I'm not using my illustrative tool all that much. I will again, we're sitting just shy of 95 on the weekly chart. Again, this is the most I can do on my screen. I'm pushing the plus button. I'm not sure if you can hear the error signal on Trade Navigator. It doesn't actually allow me any more time, hence why I need to go up to that next larger fractal, which is the monthly time frame. Again, I'm doing this for a reason. I'm trying to set, of course, the narrative and the theme of what you should be looking out for in the world of financial markets, or at least, pertinent to that of the US markets, just to try and, of course, keep your greed in check, or at least keep your risk understanding and profile or also sort of in balance at this particular point. This is the S&P 500 on the monthly time frame. Again, if I go out and start showing you some of these parameters, we are now above, of course, where we have been dating back to, and I mean, this is the chart that I was looking at, 1940, 1930, you can see on my screen. This goes back to 1929. So major warning signals across the board. The last time we have been this overbought was prior to, or towards the end of 2006-07, and the last time where we got up to this level, where we started setting off some major divergences over a number of years, was the bull market acceleration from 96 all the way to 97. And what coincided with that bullish ascent were some relatively large pullbacks. Now, again, this is historically speaking. When the RSI gets up into these levels, you go into pullbacks. Now, again, it doesn't really take into consideration the percentage pullback. The reason why is because the S&P 500 is marching up to 3,000. We're only taking into consideration the difference between 1,500 and that down to 720. But this in and of itself, 1,500 down to 720, is almost a 50% market crash essentially. But what I'm trying to show you is that along the bullish upward peak or the move of the bullish trend, you saw these large flash crashes, so to speak, okay? And this is what I'm somewhat worried about at this particular point. I'm not here to alert you or to warn you and to say that the sky is falling, but at the same time, I'm trying to keep a really sort of rational, level-headed sort of look and non-biased sort of objective look at these markets, and to sort of say to you and to suggest that the likelihood of a material pullback as we continue in the bullish direction. I'm not saying that the large macro trend is changing. What I am saying, however, is that the likelihood of a pullback, a material pullback that might shock a lot of people if you see the market fall 10, if not 20%, in my own personal opinion, is moving, is coming closer and closer the further and more parabolic we move to the upside. And this is collectively across the board. Now, again, if I go into the NASDAQ, this is a simple exercise that I'm performing with you, but I hope you're finding the merit and, of course, the value in looking at these metrics. The RSI has pulled back down, a relatively interesting circumstance. I will obviously go into the daily sort of candlestick look at all three of these markets, but the RSI printing at 8180. This isn't as historically high as what we have been, of course, for the NASDAQ, but when we start going out into the larger fractals, this is the weekly look. You have to say to yourself or ask yourself the question, when was the last time we were this overbought with tech stocks? And the answer to that question was, again, going back to the year 2000, where we coincided with, of course, the tech bubble. Again, I'm not calling this the top of the market, but I am assuming that at this particular point with this bull market advance that we are ushering in a little bit of a frothy type of sort of market valuation, which I think everyone or any fundamental investor can essentially agree with at this particular point in time. Again, during that bull market advance from about 95, 96 up to the top in 2000, we went into a series of corrections. If I can zoom into this on the weekly chart for you, you can see for yourself, if I go back in history, we did usher in some major sort of corrections. You can see that here we were printing at 2,000, for instance, and we closed at 1,500, a 25% drop in the NASDAQ, which essentially allowed those oscillators to reset. What happened was that the market continued in the bullish advance. What I'm assuming is, again, just to make this very, very clear, is I'm assuming that we are going to have to move into that of a retracement, which is probably going to crack the 50 exponential moving average. However, it should, of course, print that next higher low, and that will be the time essentially to start legging into a bunch of bullish trades or market directional trades on the ETFs, which I personally would feel comfortable doing at this particular point in the market, being as stretched as what it currently is. Essentially, where we are right now on the Dow, on the S&P and S&P 500 and the NASDAQ are at the peaks of these RSI readings. If you sort of, read between the lines or essentially listen to, the narrative and the theme of what I'm talking about now, every time the RSI has come on up to these levels during that of a late stage bull market advance, essentially what could be happening is that we are, or what you would be doing is buying at the tips of these line charts, as you can see, before and prior to that inevitable material retracement. The smartest thing to do at this particular point is to be looking to buy off from the exponential moving averages. If you're looking for that bullish trend continuation, that comes with the lowest risk, with the highest probability of a favorable trade outcome. And I'm really doing my best at this particular moment to gauge this market, to frame this market, to give you the nucleus and to give you the blueprint of what I'm looking at personally and just sharing with you, because again, I feel as though a lot of people are going to be caught very much so off guard when this market changes. It's not a matter of if, it's simply a matter of when. Now, if we go back out, of course, to the monthly time frame, this is going to conclude the three fractals of the three markets. This is the monthly look of the NASDAQ. Pay attention to this. 96. 86 was the last time, or the first time we've actually printed around 90. The second time was in the year 96. Then, of course, the top of the market in 2000. And since 2000, the NASDAQ itself hasn't been as overbought as what it currently is. The last time we got up into such elevated levels and we held at these elevated levels was prior to the major consolidation which took place in the years 2015 into 2016, which set up a bunch of consolidational trades, buying off support, selling at resistance. But essentially what happened was that we framed the resistance area for a period of almost 2 years on the NASDAQ. So, and I mean, just to make things essentially as crystal clear as they can possibly be, the RSI on the NASDAQ is now above where we were leading into that 2-year consolidation. You can see over here that the print of this was below 90. We're pretty much at 92.50 at the moment. So we are already stretched above those past historical levels. And I just wanted to make that very clear when it comes to actually setting the theme of the market itself. Now, again, we're looking at 3 different time frames. We've got the daily, we have the weekly, and we have the monthly. Going back into the discussion about this decelerating fan line that I've been sort of eyeing off at 26.3, to me, where it seemed as though the market had a high probability of slowing down, even allowing a little bit of variance in that. And again, this is going back to the bull market in 2009, what started, of course, this monster bullish macro trend to the upside, which has really enriched a lot of people around the world, which is, what everybody wants. Anyone who follows financial markets and has a vested interest in them. I'm still under the assumption, the suspicion that with the varying sort of degrees of variance, and of course stretching that out over about 9, if not 8 years, we are still in that sort of X spot as to where this is lining up and coinciding with, of course, those RSIs, the collective RSIs being as overbought as what they currently are. So I hope that makes sense for you. I hope that sets, I guess, the narrative, the theme of this market again. Sometimes I move into the week like I did last week, and I feel quite okay to actually really not do anything. I mean, last week for me was a relatively inactive week. I mean, truly, it was a week where I essentially didn't do anything. And I mean, it wasn't from an actual point of laziness whatsoever. I'm just understanding, of course, the risk, and I'm not buying into, of course, that psychological or the sentiment at these current highs. I mean, if you pay attention to what happened mostly during the week, we largely moved sideways up until Thursday, where we definitively moved above this resistance area. On Wednesday, I was watching the market like a hawk, and we didn't actually close above this resistance area. It looked as though we were trying to reverse off from it. However, again, on Friday, we started to accelerate and continue the bullish trend. We closed up 223 points. So over the past 5 days worth of trading activity, I might have just circled 6, but I'm trying to circle 5 as I speak to you. Essentially, half of the week's gains came from the session on Friday alone, which is a little bit deceitful when it comes to the actual weekly candlestick. If it wasn't for Friday, the candlestick itself would be largely different, and I'm trying to point that out to you as well. We are getting a little bit creative and constructive in the world of, I guess, weekly candlesticks, and of course breaking it down into that of a more so minor level, looking at the 5 individual daily candlesticks. But it is worth pointing out, because if you just go through the larger metrics, or the more sort of common metrics that people will do, they'll look at the simples. I mean, not everyone does this, by the way. Essentially, I mean, I couldn't put it into a percentage of how people trade the financial markets, but this is what's worked best for me. And this is what I share with people as well. But if you look through the lens of this, or this type of perspective on the financial markets, you'll simply be seeing no reason to actually be cautious, other than, of course, some of these oscillators, which are still continuing to register just extreme overbought levels. I mean, we're still holding above the simple moving averages. I mean, we're still trending above the exponential moving averages. You can see price action is actually newly accelerating away from even the rising 10 exponential moving average. This market is so strong at the moment that as we entered into this very brief, albeit you can barely even call it that, of a slowdown, we didn't even actually tag that rising 10 exponential moving average. So the market itself, the last time we tagged the rising 10 exponential moving average. Now pay attention, this is obviously the market index itself, not an individual stock, so this is even more rare, was actually in the year 2017. I mean, you can see for yourself, we haven't actually tagged or touched the 10, moved below it for the Dow Jones Industrial Average for the entirety of 2018, or really at this particular point, most likely for the first month of 2018. So this market, if you just look through again the general metrics, there's no reason to actually be all that concerned if you're only paying attention to the last 2 to 3 months. Okay, but if you start breaking it out into data, recordable data on the industrial average, which goes back to the beginning of the 1900s, then it becomes very concerning. And that's why I went through that simple yet very effective exercise with you just a little bit earlier. And I really hope that you take that for what it's worth. Because I myself, I'm looking at this like gospel, essentially. I mean, it doesn't lie. It's just the straight shooting truth, so to speak. And you need to be prepared and to actually understand this, because it actually makes you feel very comfortable. Not actually taking, of course, or jumping into the market at these elevated levels, okay? If you want to, you can do that, and that, of course, is your personal opinion. 26,666, that is a number that I wouldn't want to jump into the market at, so I will have to move it up or actually move it down. However, at this particular point, once again, my trading software is now non-responsive. So just bear with me again. Trade Navigator loves to do this as I bring up this Snagit record on my screen. So what I'll do, I'll press the close button. I will exit now and just simply reopen that of my Nav suite. Just bear with me a moment. Sometimes it does this. You know the reasoning for that. Again, I believe it's a parallels problem, probably an outdated Mac OS or Mac OX or whatever it's called, software problem on my end, because I run, of course, the illustrative tool that I'm just scribbling on my screen right now, because it's the only one that I can find that actually works with a version of Mac, which is probably entirely in and of itself silly, but I'm pretty comfortable with the actual controls of how I go through these classes, hence why I don't really want to change things at this particular point, because they work rather smoothly. But getting back into this as well, I mean, you can adjust it as you see fit. I just adjusted that stop. Let me just undo that. I don't like ever changing those past triggers or targets or stops. I'm going to make this a dashed line at this particular point. Again, I just want to reiterate, earnings this week, this is going to be the end of our earnings. These dreaded E's on our screen that appear down the bottom, they are all going to be nil. They are all going to be in the past as at the close on Friday, which I just cannot wait. I'm championing for that because already, even when it comes to IBM, for instance, these next crop of new trades are setting up. So it really, again, at this point, it's just coinciding very, very nicely. And I want you to understand that at this particular point, all right? But the Dow Jones Industrial Average, if you want to sort of discount and discredit what I've just gone through, that's fine. And I say that respectfully. I honestly do. If you want to jump into the market, 26,684 is a realistic sort of entry. What I am concerned about on top of all of this as well is the actual candlestick on Friday. If we were to see that of an upper wick, like say for instance here, or even here, I love placing triggers above upper wicks. The reason for that is because it indicates selling pressure. So it is that last sort of hurdle for the market itself to jump through before you actually get triggered into bullish trades. When you don't have an upper wick and it closes on a Friday, it can be rather volatile because you can start the week on a Monday essentially like that. And then that's the sort of the sell signal that you're waiting for. So if you don't feel comfortable jumping in at 26,684 first thing Monday, I'd essentially leave this, and I'll be paying attention to this, but look for a candlestick that gives you an upper wick, that gives you that first sort of slowdown or at least potential resistance area, and then bring your trigger up above that candlestick. I cannot do it for you now. Obviously, as I record this, it is a Saturday, but it is a pretty nifty tool when it comes to jumping into not only indice trades. Say, for instance, you want to position yourself once again into the diamonds. But of course, if you want to do this with individual stocks as well as they near breakout levels, okay, as they move back up into resistance levels, but they haven't actually generated the first slowdown candlestick that we generally see prior to, of course, price action breaking out in correlation or in conjunction with, of course, the CCI and the ADX turning up as price breaks above that resistance swing high. So it is relatively straightforward. At the same time, though, I am prepared essentially to actually place in a bearish trade at this particular point as an insurance policy. 25,822 I'm going to keep on my screen. You can call me absolutely crazy. I understand the rationale for that. There's no reason to be bearish, but at the same time, looking at those metrics and potentially wanting to insure yourself or have at least a trigger open to take advantage of some extreme market volatility coming up over the next 1, 2, if not month or so, we can start toying around with trades, say 25,822. I'm not saying that this is going to be hit obviously on Monday, Tuesday, Wednesday, Thursday, or even Friday, but it is there, and I would essentially keep it in an actual open sort of contingent order in your trading account, because if we were to see a very, 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 very large day worth of selling, which at this particular point, I mean, honestly, it can happen really out of the blue. All right, really out of the blue. The similarities between where we are now in the late 1980s are exceptionally high. Very weak dollar, widening trade deficits. Again, budget deficits as well. Slowdowns in economic activity. The GDP print, I believe, came in at 2.4 or 2.6%. The parallels, and again, if you take out, I mean, I'm just running through this off the top of my mind, but if you take out, of course, the drop in the savings rate, the GDP figure actually dropped. The fourth quarter would have dropped to less than 0.6%. There was a massive drop in the personal savings rate, which is accounting for largely the increase, or still is an estimate which wasn't hit. It was actually a missed estimate of fourth quarter GDP. But again, if you take out the drop in the personal savings rate and you go through the calculation of GDP, the GDP true figure, if the savings rate was kept same, was coming in, again, below, I believe, 0.6 or even 0.5, okay, of 1%. So, again, there are a lot of, again, parallels and similarities between the late stages of the 1980s, which ushered in the flash crash, so to speak. And this is something that I'm somewhat concerned about. I'm not going to say that it's going to happen, but I think it is relatively smart to have a trigger, which is still a long way away from price action on the downside. If we were to see some strange market event happen over the coming weeks, if not months, okay? So we're going to be slowly bringing those triggers closer to price when the market slows down. Now, the S&P 500 at this point, 2,872, it looks like it's galloping up to 3,000. We may actually get there, which would be fantastic. I mean, all the power to the S&P 500. We've got another long day Morobozu candlestick on Friday, which is great as well. So it looks as though the market wants to continue higher. If you want to jump into it, by all means do it, but just understand the risk. 2,877 is the next logical area of the breakout. You could have your trigger as low as 2,823. If I bring up these exponential moving averages, it makes sense. I mean, you're still looking about 220 points up to that 3,000 or that 3K level in the S&P 500. You've got a pretty decent risk and reward. You've got about 50 points of risk here. And I mean, there's no reason not to consider that. But of course, again, the reason why I walked through the actual overbought levels of these markets was for a reason. And it was to put it in perspective, really going back to the beginning of recordable financial metrics. And it's the only time in my trading career, full-time trading career, where the market has been as overbought as what it currently is. And for any active market participant out there in the world living today, there hasn't been another time in history where the market itself has been overbought collectively across the board. On top of that also, there is a very, very minor divergence occurring between the transports and the industrial average. Not enough to really sort of go through or to be all that concerned about, but there is starting to be a divergence, which I might just, very quickly talk through with you about. But before we get there, however, you can see across the board, I don't need to explain the other two oscillators at this particular point. MACD's trending. Stochastics has been overbought for 3 weeks or so, but again, that's just largely expected. The ADX and the CCI, I mean, pay attention to the ADX on the S&P 500. This is something that I haven't spoken about, but if I do just gauge this or at least frame this for you, we're printing at 75 on the market. The parallels between the actual ADX and the RSI are there as well. There hasn't been a time going back as far as really 2011 where we have been this extended in a trend. It does, of course, assume that the trend is legitimate and healthy, which it is. But at the same time, when you see that ADX turn down, that is the first warning signal. So to add this into the current juncture where we find ourselves, our current predicament, humming and hawing as to whether or not we feel comfortable jumping into this market as overextended as what it currently is. Just a reminder that ADX is printing at 75.2080. If I bring this up on the Dow Jones Industrial Average, I'll just zoom out so I can do this for you. The Dow Jones is up here at 83. Now, if I bring this up, this is eclipsing the peak of where we were in October 2017. This is also going back to December 2016. So this is going back over a year now, where we moved into this 2-month consolidation where the Dow Jones Industrial Average essentially flatlined. Maybe I can bring this up for you. See this period here. I mean, this is all that may happen, which would be the best outcome. But what you need to look at is when that ADX turns down, we go into a reset, we go into a consolidation or a pullback. And you need to understand this. You need to find confidence in this analysis because it will save your bacon, essentially. Now, again, there is no signal at the moment that ADX is turning down on the industrial average. There's no signal at the moment that it's turning down on the S&P 500. But when it does, I will update you. I will be the first to update you on this. Now, what is interesting, and this is what I wanted to speak to you about, is that the NASDAQ itself is starting to throw off different candlesticks. Pay attention to the industrial average on really Wednesday, Thursday. I mean, really, yeah, I'd say Wednesday, Thursday, and then, of course, Friday. The last 3 candlesticks, we got one spinning top on Wednesday, and then, of course, the continuation to the upside. On the S&P 500, we had a spinning top and then another little sort of nothing candlestick, then that acceleration on Friday. If you pay attention to that of the NASDAQ, on Wednesday, we had an outside day Morobozu candlestick. And again, this was when the industrial average threw off that spinning top. So I was looking at this and saying, well, it looks as though that resistance level, of course, give or take probably a couple of 100 points, as I've already sort of outlined to you in both privately and publicly as well. On Wednesday, I was sitting here and I was saying, well, this is, there's a high chance that this is actually going to work out. And then on Thursday, of course, we saw the continuation. We didn't actually break below the low of Wednesday's lower wick here. And then we saw the continuation on Friday. The continuation on Friday is that of a one white soldier. So this is another very bullish candlestick. But the volume on the sell side on Wednesday and Thursday is actually higher than the bullish continuation candlestick. And again, that bullish continuation candlestick is exceptionally strong. It's the second strongest candlestick that we have when it comes to 2-day reversal or continuation signals. So it is a very strong signal. But what is interesting to note is that on the ADX itself, going out and completing this exercise, really moving 360, through all 3 of these markets, the ADX is as high as what we generally see. I mean, if you go back to the ADX and pay attention to this, I mean, there's been a couple of instances since 2011 where the ADX has momentarily just peeked its head above it, but you're starting to see what happens when we get up into these levels. If I zoom out and show you this, I mean, this is just the ADX. I mean, it's not the best example, but really in the month of May through to the end of June, we went into a very small correction. That correction would have coincided with the market moving back into that rising 50-day exponential moving average. You can bet your dollar on that. Again, when we moved into this overbought reading at the peak of July, at the end of June, we moved sideways. We rallied. We made another higher. Then the market went into a temporary free fall as the market sort of stagnated and stalled out just shy of this 4,590 area over here. And then the last time prior to that, or the next occasion, was in the month of March 2015, where we went through this period. And this was a very, very, very profitable time. I remember this as clear as day. Towards the, at least the midpoint of 2015, the market was slowing, and it was slowing, and it was slowing, it was slowing. We were throwing off divergences all over the place when it came to the MACD. Even the stochastics, and of course the RSI. And then we got into this big reset into 2016, which was what really ushered in this large correction that even I myself was getting very concerned about during this period over here. So I think personally we're at the beginning of that of at least a consolidation. We're probably going to usher in the resistance area. The ADX, if you haven't already seen it on my screen or noticed it for yourself, is potentially trying to tone down. I mean, it's tried to do it, but essentially right now it's trying to turn back up and continue the bullish trend. That's coinciding with that one white soldier. But I'm harping on about this for a reason, okay? I'm harping on this for a reason, okay? I'm concerned. And when I'm concerned, I'm going to share that sentiment with you because, I firmly believe it's in your best interest, as to the reasoning for that. The ADX has turned down, or it has begun to turn down on the NASDAQ, something which it hasn't done on the industrial average or the S&P 500. And again, when you see these signals, pay attention, take note, very, very important signals. The CCI across the board is still trending. When it comes to the Bollinger Bands, we're still trending as well. We're still holding back up above that 18 simple, but it looks as though across the board, we're doing everything we can to push on back up into the Bollinger Band. This is not sustainable. It is not sustainable, but the bottom band has turned up. That is, of course, recognizing that we are in a bullish trend. I mean, that goes without saying. The problem is if you try and use the Bollinger Bands to predict trends, when the bottom band turns up, you're pretty much at the end of the bullish move as well, okay? So, or the bearish move as well. So you don't use, of course, the Bollinger Bands as a trend indicating signal, unless, of course, you start to print the reversals, which coincides with generally double tops. And that's the best reversal signal that you have when it comes to Bollinger Band trend trading, or at least trend reversals. And I want to again, stress that to you as well. So outside of that, everyone, that really sets the tone for the market. I mean, if you want to jump in bullish, by all means, take the risk. I'd encourage you to have a second sort of thought before doing so. But at the same time, I don't blame you because this market is continuing to trend, and we really don't have any major reversal signals outside of course, just how overbought the markets are, which I think is largely concerning at this particular point, and the NASDAQ, where the ADX, as extended as it is, not only on the NASDAQ, but the industrial and the S&P 500, has just had a downtick, and that is a very important correlation signal, at least a sell signal, temporary sell signal, that active market participants, especially swing traders as well, need to notice, and I'm just bringing that to your attention as well. Let me have a sip of water, and let's continue with I was going to say individual trade analysis. Before we get there, let's move into the US dollar. It's very exciting to see what's happening, or at least to go through what's happening with the US dollar. But again, let me just have a sip of water, and we'll continue. Okay, so US dollar broke that definitive figure, 89.92. That was on Wednesday when this occurred. A lot of this is coming on the back of the Fed remarks, and of course, the weak dollar sort of status that I believe Trump is looking for to help exports and to spur business growth in the US. This is a trend continuing at this particular point. All right, a trend continuing at this particular point. The bottom looks to be essentially falling out of the dollar. However, it's not a bottom that is just going to continue. My target on this, or at least the trend that's going to continue, my target is 88.22. We got very close to this the following day after we broke 89.92. If you're in UUV, congratulations. It is a profitable trade. We have a lower wick on Thursday. We continued the selling. a little bit less velocity, I should say, on Friday. We were down another 33 cents, but this is a very weak trend, or a very strong bearish trend for the US dollar. If I bring up all of these indicators, I mean, you see for yourself, the exponentials are trending bearish. We're below the 100 and the 200. All of these oscillators are extremely oversold. I was looking at potential divergence setting up on the dollar. That is essentially pretty much at this particular point blown out of the water. At best, we are making relative lows. So I guess we cannot even make the case at this particular point for bullish divergence. We did have, of course, the contingent trigger here at 94.27 if the market was to bounce, or at least the dollar. We didn't have really a bullish trade on the US dollar last week whatsoever. It was just the bearish contingency which was hit. The ADX again is extended 73. So if you're in UUV, look to exit. This is close to 88.22. When we get to 88.22, I'm assuming the US dollar is going to stabilize short term. There's probably going to be a collective sigh of relief for dollar traders, or at least dollar bulls out there, but this is not a strong support area. 88 is not a strong support area. To alleviate just how oversold we are, we're going to have to allow these oscillators to actually reset. So what is most likely going to happen is we're going to tag 88.22, or we may have put that low in on Thursday, which was very close to my personal target. And what you want to look out for are bullish reversal signals. If you see these, it's best to close out the UUV trade. Essentially run its course. It's been a very quick trade, but at the same time, you should see a bounce back up to these declining exponential moving averages. We may bounce as high as 92. I mean, that would be a pretty tremendous rally considering the damage which has been done since 95.50. And at this point up here, this will be the next short. So it looks as though, once again, the trend is defined. There was a lot of humming and hawing between that of, the bullish and bearish sort of composition on different fractals. I was under the assumption that we were printing that over head and shoulders. Left shoulder, head. This is inverse, of course, in the right shoulder. We were breaking above at the retest over here. That broke below this green box, and then that was the retest over here as to where we started to see the trend. So a lot of humming and hawing on different fractals. It looks as though the direction of the US dollar has been set now that we've broken definitively not only 92.75 but also most recently 90.79 and also 89.92. So I have a bearish outlook on the US dollar. I've changed it as the chart has changed, but there really is no reason to be bullish on this except for the simple fact that we are extremely oversold, which is relatively inverse to this sort of the setting of the market itself. And you should be expecting that of a bounce for the US dollar. Now, instead of going through this on the US dollar, I'd rather speak about gold and silver, because as the US dollar continues to break down, and I'm assuming it's going to continue the bearish trend into 2018, it was an exceptionally sort of weak year in 2017. I love the composition of this chart at the moment. The reason for that is because we've produced a high, now marginally higher high, and we're still setting up a series of higher lows. It was looking as though we were going to crack 116 or hit our target at 116. It's reversed. We're trending to the upside. Again, we've just broken this swing high. And on top of that, we have an upper wick on Thursday. This is the type of candlestick that I like because it sets the tone for the breakout, which is inevitably going to come once we pierce above this. So last week, we tentatively placed a 131.45 entry. I love this trade now. I'm simply going to move it down. And this is a definitive no-brainer. 130.83 on the upside for gold. And that is, over the coming weeks and months, going to take us up. I mean, I have to go back out and just to put this in perspective, because it's very important you understand this. Once we get above this 130 figure, this 130 on the actual ETF has been major resistance since August 2013. Okay, once we crack this level, there really isn't any resistance until we come on back up and retest this pivot point over here. This is going back to April 2011 as resistance. It's also acting as support in the years, or at least the late stages of 2011, but also into 2012 until we definitively broke it in the year 2013. So if you're looking at this trade setup, it's an absolute no-brainer. 130.83 up to 150. This is the first decent trade that I have, that we've had collectively on GLD when it comes to a risk and reward breakdown. So this is essentially, as I go through the list, one of my favorite trades. You have to allow, of course, a little bit of market volatility. There is going to be a little bit of probably selling around 130 when we get there. But what you should pay attention to are these exponential moving averages. As long as we remain above the 20, but most importantly the 50, this is a ticking clock, a ticking time bomb before we see gold and silver pick up and really explode from 130 to 80, 130.83 up to 150. So you're looking at this and you're saying to yourself, well, I've got about $20 on the ETF. Once we break above 130 130.83. Let me just reiterate, $20 on the GLD ETF once we break 130.83. So this is most likely going to be the first care package, the first parabolic trade, the first major trend trade, similar to the likes of Caterpillar. I mean, take your pick out of our top 12 individual trade list when it comes to trending stocks, but it's going to be a monumental, massive move when it happens. 130.83. I cannot stress the importance of that trigger. You might be in at 128.54. I hope you have enough time on your options. I would have them out as far as there is enough open interest. Okay, I'd be looking at May, if not June, if there is enough open interest above 180.33. If you're in at 128.54, add to it, but of course, add additional time because you want to take advantage of the trend as it continues higher. Now, again, an absolute no-brainer when it comes to silver as well. Silver's got a little bit of a different chart. We're still trying to break above that relative level over here, just above $17, but definitively, it's going to follow suit. If you look at gold and where we currently priced at, it is essentially being at about 1943. Once we get above this peak, really silver's going to explode. So you can say to yourself also, and this is what I like to do when it comes to, I guess, the intermarket analysis and just how closely or parallel these two markets are together. If gold breaks above that previous trigger we were talking about, you can enter into market positions on SLV because SLV is going to follow gold. Okay, so I mean, we can break a couple of rules, and I mean, we're sort of bending or blending the rules. We may not be above resistance when we enter into the trade, but these two, obviously commodities, they're related. They follow one another. They are correlated. So if gold breaks 133, the previous entry, silver, you can set up, more or less contingent market orders at that current price, whatever the ETF is printing at. It might be at 17, it might be 1720, 1730. But again, as long as gold breaks its relative resistance, SLV is going to trend, and it's going to trend a lot higher. First stop is really going to be $20 on the ETF. But when we get above 20, again, we're looking at prices going all the way back up to 25. So there is a lot of opportunity with both silver and gold. Out of silver and gold, I like them both compared to that of the US dollar. Okay, GLD. Sorry for my writing. I would take the GLD and the SLV trades every day of the week over the opportunity on shorting the US dollar at this point. I would not short the US dollar until it bounces, retraces back up in those declining exponentials, and then that's going to be the short if you want to trade UUV. Otherwise, you've got a fantastic, I cannot stress this enough, great trade on silver and gold moving forward. All right, it's just a matter of time, in my own opinion, until that breaks out. Let me have another sip of water, and let's get into the individual trade analysis. Okay, so before we move into the analysis this week, I just want to reiterate I think this is going to be the third time. My apologies for doing so, and hence why I spent so much time on the market analysis previously. So we have Apple, Amazon. They're reporting on Thursday along with COP and Google, for instance. We've got 4 stocks. Let me just illustrate this for you. We have 4 shares reporting on Thursday. Okay, Thursday. Outside of that, on Wednesday, we've got Boeing Airlines, and on Friday, we have CVX. Once we oscillate through this list, with the exception of Baidu, we have now gone through finito our top 12 individual trade list when it comes to shares that we can trade, or at least immediate share opportunity. I mean, we're pretty much 6-6 at the moment. That's including Baidu, which is yet to actually announce their earnings. So things are looking good. We're halfway through. I'm happy about that, but at the same time, the reality is we still have stocks reporting. What I'm going to do when it comes to what I'm going to do, I'm going to speak about Apple. I dwelled on it at the beginning, but this is a really great learning opportunity, so I am going to speak about Apple. But when it comes to Amazon, Boeing Airlines, COP, CVX, and Google, I'm not going to talk about these. The reason for that is because there's no trade set up. This week, I'm going to be speaking about Apple, Baidu, Caterpillar, Goldman Sachs, IBM, Netflix, Tesla. And then next week in Pro, we're going to have a top 12 list that we can do everything with. We're going to have bidirectional trades after earnings. We're going to have gap trades, hopefully back tests, bullish continuations like we saw on Netflix during the week or towards the back end of the week just past. And it's going to be great. At this time, though, it's pointless me wasting your time going through those 6 stocks which have to report earnings, less Apple. Now, the reason I want to start with Apple, or at least not start with it, but actually speak about Apple again, is because it really fits the narrative of being forced into a corner and being forced to act when you don't necessarily want to. Apple is a fantastic trade setup, okay? If you're looking at Apple at this particular point over here, this is an absolute no-brainer trade. Now it is, this right here is meant to be a dashed line at this particular point, okay? It's meant to be a dashed line. You can all agree on this. The reason why it's dashed is because we've had the conversation that earnings is too close, okay? There's not enough time before entering into the trade before having to actually close out of it prior to earnings. Hence, the trade is corrupted. Now, as you can see, and this is really the best explanation for this, Apple is turned, okay? Weren't fooling around. If you took the trade 175.02, you only had about $2.50 of risk, which is great, although it is a negative outcome. But again, it goes back to the nucleus and the explanation as to why you do not force yourself into trades prior to earnings. This is the entire FOMO sentiment that people are buying into at the moment when it comes to the market direction and, of course, the parabolic movements that we continue to see to the upside. So a very good explanation, a very good illustration, a very good example of real world sort of settings, okay, that you're forced to act upon or at least forced to make decisions about. That, of course, you need to be aware that psychologically and emotionally, you may be tempted into, of course, breaking definitive rules when it comes to earnings and, of course, trade expiration when it comes to taking the trade. I cannot stress enough. If there's simply anything that makes you uncomfortable, one being earnings, don't take the trade. And this is just the perfect example of this. I can say, I can sit here with good confidence and I can say if we did not have earnings scheduled for Thursday, so just say we were looking at this particular point, there was no earnings, this would be a bull flag and Apple would move to the upside. What has happened since is that as we've drawn closer to earnings, there has been details coming out to the lack of interest and demand of the iPhone in particular in China and the actual slowdown in the manufacturing and production of the iPhone itself and the actual clientele, the customer base in China, which is actually shrinking. Okay, so on the back of this news, as we are speculating, or not we, but as institutional investors are speculating on, of course, the weak earnings report. And again, Apple's a really tricky one because when you have earnings and if it comes out to be, or if it tends to be a weak report, the stock gaps up. So just be wary of this. Apple's renowned for this. If it's a fantastic report, it generally gaps bearish and then continues bullish. And if it's a weak report, generally it gaps bullish and it can either continue bullish or pull back, close the gap, and then continue. So just so you're aware of that, it is a relatively interesting sort of inverse relationship when it comes to the actual report itself and how people interpret it or what people do post-report. But again, I just really wanted to sort of speak about that because, I try and go through these real-world scenarios with you and do my best to... I understand how difficult it is to do nothing. Do not get me wrong. I understand how difficult it is not to do anything. But at the same time, it took me, as a private trader, a really long time to feel comfortable doing nothing. And I mean that with all due respect. Again, it's not a point of laziness whatsoever. It is a point of being astute. It's a part of being intelligent or having at least the wisdom to know better when it comes to trading the financial markets. And really, it just comes with experience and it comes with time. So it used to be very problematic for me to simply not have a bunch of trades set up for the week upcoming. But now it really doesn't bother me because I know in the past, I've had to sort of move through this and essentially create battle scars for myself and of my own, is that it's not worth it. It's not worth it. And this is a fantastic example of people pushing the boundaries of trade setups, trades executions, and actually having to liquidate this prior to earnings and actually coming out $2.50 on the downside, all right, when it comes to Apple. And it's important that, hopefully you didn't take the trade. We went through enough reasons as to why you shouldn't take the trade. And secondly, if you gave into temptation, hopefully you can journal that down and never repeat it. Because I know it's repetitive. I know when earnings comes around, a lot of people in this class around the world, they get rather frustrated, rather annoyed, and it's out of my control. It purely is out of my control. But all I can do is, again, just give you the honest reasoning, moving into it, progressing through it, and then coming out the other side, which is all what we collectively want. And I'm so very happy to say goodbye to this earnings season as at Friday, when it is specifically relatable to our top 12 trade list. Amazon, continuing earnings, not talking about it. If you're in it, liquidate the trade. Boeing Airlines, the same thing. Earnings scheduled for Wednesday on Boeing Airlines. It's going to be the first stock, or at least the second half of our reporting list. That is reporting this week, the first on Wednesday. Boeing Airlines, liquidate it, be done with it. There's no trade at this particular point, never moved above 353. Forget about it until later in the week, if not in pro. Baidu, the first stock that we can trade. Hallelujah. Baidu 238, 242, 255. We're now, or at least the most recent trigger, 258. This is another one white soldier. We're holding at 260. So all of these trades at the moment are profitable. And this slowdown which is taking place is as we close this open gap. The open gap is now obviously closed. So if we can break above the wick of this candlestick, and of course most recently on Wednesday, we're going to gallop and we're going to run to 271. What I'm concerned about is the state of the financial markets, collectively, the indices themselves. So obviously, as I just progressed with you into the actual talk as to how overbought these markets are, that is going to have some form of an influence as to what happens with the short-term price expectations of Baidu. So what you can do, and again, this is the best course of action in my own personal opinion. If you're in at 238 and if you're in at 242, keep your trigger at 249.52. Okay, it's a no-brainer. It's a profitable trade. You've done well. Congratulations. If you're in at 255.02, really essentially the best stop for you is still at 249.52. It simply is. 258.28. You're still talking very close to $5-6 of risk, but really the best stop again for you is 249. I can move this up, but as I do, the risk of being stopped out prematurely goes up a little bit higher. If I bring up these exponential moving averages, I know generally we don't apply these during that of consolidation of market between resistance and support, but essentially what's happening right now is that we are potentially on the precipice of actually trending. I'm a little bit concerned as to what happens with the state of the markets, the indices, but if we do get an acceleration above the high of this week and this week, this is running to 271 and we'll all be very happy about that. But if you really wanted to mitigate your risk, and if you are somewhat concerned about the state of the markets and you simply don't want to be playing games, if you don't want to be having that $5 worth of risk and you're pretty happy to sort of liquidate this trade at this particular time, I don't blame you. If you want to move it up pretty much to a net negative, a neutral pretty much sort of entry and exit or stop at least on the trade. 255 was the breakout entry. Okay, 253.37 is where the stop can be placed. That leaves you with about $1.63 of risk between the 255 and 253 stop. All right, so take your pick. Essentially, take your pick. It's up to you. But again, you know my thoughts, my concerns on the market, and it's really autonomous. Of course, the decision is autonomous for yourself. We all hope collectively it's going to run. Okay, it hasn't really done all that much this week over the past 5 days worth of trade. It's up $4.27, so it is, pretty decent. But at the same time, I wouldn't be really risking all that much. In fact, as I just dragged this over, I did say at the beginning of this recording that Baidu generally releases earnings at least a month, if not 2 months after generally our top 12. You can see on my screen, earnings is scheduled for the 22nd of February. So there is plenty of time to run this up or to hold up to 271. But at the same time, you have to be wary. You can write this down. What was it? The 22nd, I believe, of February. That's obviously bound to change. It doesn't have to, but generally it does. But it is giving us a general vicinity as to where we expect Baidu to release its earnings. No bearish trade on Baidu. We are at a support level. Okay, so resistance turns support. You can even see on Monday this long lower wick respecting that actual sort of support level there. All right, so think about that. Pretty decent trade set up on Baidu. Or at least not so much a trade setup, but trade management when it comes to the stop. It goes without saying the actual risk and reward on the breakout above this week and this week doesn't justify the trade up to 271. If we get above 274, that's going to be a breakout trade, and it is going to continue. I think it just needs a little bit of time before that happens, and of course the market needs to cool down a little bit. But if we get above 274, this is going to be that next trending trade, indefinitely further into 2018, and we could see that of a Caterpillar. Take your pick as to any of these stocks which has been trending over the past 6 months. Baidu might actually move or rotate into that next trending stock in tech if tech continues. So something to keep on your radar, and a pretty decent trade there as well on Baidu, or at least the continuation of that trade. Now, Caterpillar. This is good. Caterpillar is a trade that we can actually go through. It reported earnings, I believe, on Thursday. I was going to say Wednesday. On Thursday, this is a big lower wick, okay? A large lower wick. Look at this candlestick. I was relatively amazed by the actual intraday trading activity on Caterpillar, but This was essentially that of a retest, a tag of these rising exponential moving averages. So we were concerned of this trade. I mean, this has been one of those trades that we all look back and we celebrate and we can congratulate each other on, and we're just really happy that it's actually set up and continued the way that it has. Really, for the second half of 17, even into the beginning of 18, it's still trending. My last target on this, or my personal target, was 158.39, and then we were getting closer, drawing closer to earnings. I was happy with the profit that we'd all made, even as recently from 140, 143, 145 up to 158, okay? But here we are, we ran up to 168.95. This is where the stop was. We actually got stopped out pretty much at the peak of this prior to earnings. If you held onto it past 158.39, congratulate you for that if you have better foresight than even me. As humbly as, I just thought about what I just said, but I mean, you understand what I'm saying anyway. Try to be, and I am a very, very, very humble person. But 168.95 was the most recent stop. You can see this is a large sell day, a massive volume spike. We've got a long lower wick. At the same time, this is still relatively bullish. What is fantastic about this trade, and this is what makes me, if I can color coordinate this, very happy, is that we've got a long lower wick, which is retesting the rising exponential moving averages, okay? And we have a dark shaved top, flat top candlestick, which was just instant selling after the report. So what we can essentially do is set up a bidirectional trade. Very, very simple stuff. 161 on the bearish side. This will take us down essentially to the slowdown, which is going to correlate with this rising 50 exponential moving average. This will take us down to about 155. Not the best trade, I would say, because of course it is against the trend of the market, but it is an absolute no-brainer if we do it. I can just put this as a target at 155.09. I don't need to place a stop on this at the moment because even for the second retest of the 20, it looks as though we're respecting it with that long lower wick. At the same time, if Caterpillar breaks above the highs of this candlestick, this candlestick, this candlestick, and this candlestick, this is going to be an absolutely stunning and brilliant trend continuation above 174.28. Absolute no-brainer. So after this earnings candlestick, the week just gone on Thursday. No trade obviously between Thursday and Friday, but now we have a bidirectional trade. Both sides of the trade are ideal. And what I assume is going to happen is that eventually we're going to break above 174. We're going to trend most likely to $200 per share, but it's either going to be a breakout more or less from where we're currently trading, or in fact, it's going to be a breakdown below 161. Tag the 50, hit it at 155, then we're going to see a bounce, which is going to set up that next higher low, and then we're going to get the trend continuation. Ultimately, we'll be able to bring the 174 trigger down at that point, which is going to give us a fantastic risk and reward ratio, and then we can add to the trade above 174 at a later date after we've already have a vested position down here on the bullish side after taking advantage of a profitable bearish trade down to the rising 50. Okay, so long story short, Caterpillar is forming. It's not ready yet, but we've got, I guess, the parameters for that of a really decent trade. Keep this on your radar, journal it, write it down. This is a fantastic sort of non-eventful earnings candlestick. We did not get a major gap. That's great. I like these types of candlesticks. And Caterpillar is a trade which is forming. Let's move into COP. COP is slowing down. We have earnings. This fits the category of we will talk about in next week's class. If you're in this trade, you're at break even. 60.38, we went through the trade setup, the reasons for it. I can tie this conversation into that, which I previously went through with Apple. Another great example of this, the only difference is that this is a relatively neutral sort of outcome. Apple was that of a bearish outcome, or a losing outcome if you took it. But again, you can just see the unpredictable nature of this when you're forced to act before that of a certain date, the date being Thursday for COP. So get out of it, forget about it, and we'll recap this in pro. The same is true, of course, for CVX. We have not triggered above 134. I mean, this has been a fantastic trade. 120.97, 121.60, 122.36, 126.79, breakout above 129.32. These have all been great trades. I mean, I wasn't in at 129.32, hence the dash line, but you can see for yourself, stopped out at 132.08. Or actually, no, it was very close to it. I think we deleted it. It might have been 131.90 something, but you get the picture. It was looking like a bull flag continuation. Earnings date, it messes it all up, throws a cog in the works, so to speak. And as such, get out of it, and we'll recap it in a week or on next week in pro, and we'll have a pretty decent trade set up, I hope. Same is true for Google. What's interesting about Google is that Google on Friday, I mean, I will just quickly speak about this. It produced that of this is what we call essentially Dragonfly Doji. I mean, I was tossing up whether or not to call it that of a hammer at resistance. One, we're not resistance, and two, we don't have a real body to the candlestick. This is a Dragonfly Doji. If you see a Doji Okay, doji is of course the same open and close with either an upper or lower wick. This is a gravestone doji. Think of it as a tombstone. Unfortunately, that's how I remember these things. And if it's not a tombstone, it has to be that of a dragonfly. That's just the technical name for these candlesticks, but they do give a lot of information. This is a very bearish signal at resistance. We're not at defined resistance, but we could be at a resistance. This is after the slowdown which took place on Wednesday. So as it stands, if you're in this, I mean, we had past triggers 1070, 1088. Then we had these two dash lines here and here. If you're still in this, please liquidate the trade. You have done, beyond really well in this trade. Just be done with it. Earnings is scheduled very soon. I would not be fooling around with Google. A trade that we can look at is Goldman Sachs. So please just listen to me right now. Let me have a sip of water. Because, I mean, before I take a sip of water, think about what I just said with Caterpillar. Okay, think about what I just said with Caterpillar and then look at the trade set up in the past on Goldman Sachs as I take a sip of water right now. My apologies, but it's I just need to do it. Okay, so, pardon me. Goldman Sachs moved into a short-term consolidation. This was after we were extremely overbought and we were tagging, or at least testing, past resistance areas that we had essentially overcome. We moved into earnings, we back-tested the support area, and then we had this bracket trade moving into the week. 245.04, which was essentially the break of past support, and we had the peak up here at 262. Now, we weren't necessarily sure if we were going to break above it. This actually happened on Friday last week, but we got the definitive move above it this week. So, pardon me, let me just rephrase that. It was on Monday where we tagged it. I got confused with the previous stock that we were looking at. Pardon me, I feel like coughing, by the way, after just sipping that water. My apologies. I think it went down the wrong windpipe, or however that happens from time to time. I almost feel like coughing. But you can see for yourself a massive week. If I go to the weekly chart, we were up $12. A long day Morobozu definitively breaking out. This was after the earnings candlestick with the lower wick. This is exactly what I want to see when it comes to individual trade setups. Now, if I continue with this, you can see bouncing off those rising exponential moving averages. That's why we had the bearish trade placed at 245. Generally, we retest the 50. If we break the 20, that's exactly what has happened. Again, if I go into the long-term simples, they've crossed bullish prices above both, which is fantastic. The oscillators have a long way to go, unlike the markets, which are as overbought as what they're currently suggesting. The RSI is only at 69, so a long way to go. ADX has turned up in the CCI. Is it above 100? So, I mean, are we just getting a checklist of green sort of ticks right now? And the answer to that question is yes, we are. So my target on Goldman Sachs is all the way up at 298.58, okay? The reason for that is it's a psychological round number. We're printing at about 270 at the moment, about 10% from here. If you do your maths, is $27. We're looking at about a 10% move from current levels up to 300. Very close to, not precise or not. I mean, it is relatively precise, but it's not to the exact dollar amount. It does have about a 1% degree, both sides of that 10% round number from more or less current levels. We're very close to that. But 300 or 298 is the target. I mean, everything is good about this trade. There's no reason to be concerned about it other than the market itself. So what you can do is just place your stop pretty much below the low of, I do Tuesday's candlestick. I was looking at Wednesday, but there isn't enough flexibility. I just drop it down to 256, and that leaves you with about about $5 of risk on the trade. Sorry, I don't want to make it dashed. Short-term get confused sometimes when I'm going through and clicking on colors and speaking. My apologies. But you're looking at limited risk to make a lot of return on this trade from 260 up to 298. Let's just call it $40. Okay. I know it's a little bit less. It's 38 or whatever it seems to be. If you just go with around number $6 of risk, which is overstating risk, you're looking at a 5-to-1 risk and reward ratio. And that's what you want in the world of trading. And when all of this comes together, you go through the month's reset, you go through the parameters of risk and of support and resistance. ADX turns up, CCI breaks out, bouncing off the rising 50, blah, 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 blah. After earnings with the low wick, the trade just comes together. So I'm very happy about Goldman Sachs. If you're not in it, you have a choice to make. You're still at the point of potentially jumping into this trade. 262 is the actual trade setup. But at the same time, the further we go, the more risk is, comes with the trade itself. So you can move this down, really 271.29. But at the same time, you want to see a definitive move above this upper wick. If you get in at 271, personally, I'm not looking to do it. But if you were to do such a thing, I would encourage you to mitigate the general sort of position size that you would generally look at, okay? Having said that, I would, obviously make it smaller than a general position. The reason why is because it's not the best entry. The best entry is at lower prices. You can see for yourself, it's almost $10 below where we are currently trading at or where the next trigger will be. So you need to be mindful of that. But even if you get in at 271 and you place your stop here at about 265, you're looking at $6 and you still have roughly, $28 to run on the trade itself. So you're looking, I can't do the maths that quickly, but it's 4 point something to 1. Let's just call it 4.2 to 1 reward risk ratio. So it still fits a decent trade setup, but at the same time, you have to be obviously on the lookout for a potential market noise. That could be a short-term pullback, but overall, you want to have those option contracts dated into April, if not May 2018 as well, all right, on Goldman Sachs. So let's continue with that. There is no bearish trade on that. That is relatively settled. Now, this is an interesting trade setup, isn't it? I'd encourage you to go back and listen to the talk I gave you on IBM, because what we said was that, look, honestly, last week was a rather tactical week when it comes to technical analysis. Again, when you look at technicals and you practice technicals and you do enough back testing and you work with enough real-world scenarios, it becomes relatively easy to make both a bullish and bearish case, but it's also very easy to do nothing. And again, it goes back to that first or the couple of discussions I've had with you where, sometimes it's best essentially to stand or at least to sit on your hands and really just not do a whole lot. And IBM was one of those trade scenarios last week. The reason for that was because we were tossing up whether or not this is an island reversal. Okay. Again, please apologize my illustrations, or at least my drawing tool. I'm using that of an external mouse on my on a keypad here, on a mouse pad, as you say. And it's never all that pretty when I very quickly write letters. But anyway, talking about potential island reversal, at the same time, we were still above those rising exponential moving averages and still at a support level, also the backtest level of the peak over here at 160. So, all of these things were coming together. And what we were essentially doing at that particular point was that the analysis was bifurcated. You could make, again, the argument of a bullish and bearish trade setup very, very easily. But at the same time, there wasn't enough sort of price action to work with at that particular point, which is fine. And we just had to say it how it was. And that's exactly what happened. What we did say was that there is a very high chance that after this candlestick, this was on Friday, by the way, so haven't touched anything whatsoever. But what we were saying was there's a very high chance that IBM is going to rally and close the gap up at 168. That's why we drew this red rectangular box. Now, if I zoom out and show you this, you can see for yourself, here we are. This is Monday, this is Tuesday, and then on Wednesday, are you surprised? Let me just, draw a little question mark here. Are you surprised that this upper wick here is coinciding with the gap close and why there's a bunch of sellers in IBM here? And with overwhelming exclamation mark, no, you shouldn't. And you should be happy about this because you can sit here and you can come to these conclusions prior to, of course, the week's worth of trading upcoming. And with this should bring an abundance of confidence when it comes to detailing and navigating the world of financial markets. It's why I go through this with you with such tremendous detail. Okay, what I've done just then is now I've dragged down this resistance area that was sitting a little bit higher because we've got this up wick here. What we are probably going to do with IBM is if I bring up these Bollinger Bands, okay, is that we're probably going to get stuck below this resistance at 171 and somewhere above this support down here at about 161. Okay, so we've got about a $10 range here. I think we're going to move into a very low period of volatility. The top band is going to turn down. The bottom band is going to turn up. It's going to constrict price, okay? And then we're going to set up a Bollinger Band squeeze, okay? That is what I believe is going to happen on IBM. However, outside of this, okay, we have got a bearish trade set up now at 160.79. I do not think this is going to happen, but we need to place it there as an insurance policy. Also, if we go to the upside, now we have a definitive breakout at 172.11, okay? 172.11. This is going to take us on up to about 178. That is that next resistance area. Okay, so this trade is in the works. It's in the pipeline. It's not ready yet. I believe volatility is going to bubble. It's going to bubble. It's going to bubble. It's going to be that of a sort of a boiling pot. Bubbles, 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 steam, steam, steam until it sort of essentially blows the lid off that boiling pot or the kettle. And then price is going to go parabolic and take us up to 178. I cannot tell you definitively when that day will come, but I like the trade setup. We've closed the gap. It looks bullish. It looks more bullish than that of sort of a bearish outcome. And I'm pretty confident in this trade. I just simply don't think at this particular point it's ready. I believe we're going to move into a Bollinger Band squeeze. However, if we don't move into a squeeze, that's fine. We can just continue above 172. I take the trade up to 178. Relatively straightforward trade. I'll give you stops on this if in fact we do it at the moment. Again, it's too creative and it's too constructive because we don't have the candlesticks to actually work with in terms of a legitimate trade setup at this particular point. Now, we still have Netflix and Tesla to move through. I believe I've been talking for quite some time. I mean, maybe not quite some time, but I hope I'm on time. I didn't really take notice of what time I began. I'm looking at my watch now and I'm a little bit concerned. Sometimes I get carried away with the analysis. I could have been talking for 1 hour. I may have been talking for 2 hours. I'm not sure. So I've got 2 stocks to move through, and that's going to round us out in this week's class. And that, of course, is Netflix and also Tesla. 2 very different stocks. Tesla, I am bearish on. And you can see this dotted line. I'm not taking the trade, and you know why. I mean, if we crush this lower area, we're exceptionally bearish. Netflix, on the other hand, gapped to the upside on Tuesday. Again, at this particular point, I was not looking to trade it. I wish I had, but I didn't. The breakout trigger would have been above the high of Tuesday's candle. Wednesday, we broke above it, and we've just simply continued. I'm concerned about a bunch of these trades. Not the trades that we've gone through, but certainly Netflix at this particular point. All right, volume's trickling out of it, but at the same time, the trend is continuing strong. What I would love to see, okay, this is what I would love to see: either Netflix to come back down to 250 to retest the open gap and hold, or to close the gap at about 228, and then we can use either this level or this level as a bounce opportunity. Okay, I hope that makes sense. Netflix, however, sometimes has a mind of its own, and I just want to make that very clear as well. Let me just run you through some of these oscillators at this particular point. You've got an RSI sitting at 94. You've got stochastics, which is sitting at more or less 90. I mean, if I go back and historically show you this, I mean, this is why, again, there are times where you simply don't want to speculate on a trade. It's not worth it. You can see for yourself dating back to 2015, almost to the end of 2014, we haven't been this overbought as per the RSI. I mean, you can see for yourself we haven't been. If I go out to a weekly chart, we have to adjust the RSI setting, but we are moving towards the end of that zone. So it's going to be very interesting to see what happens. But do I feel, I mean, just to put this in perspective to you, when I look at the likes of Goldman Sachs, that trade setup, when I look at IBM that are working the way that we've assumed them to actually work, which is great. When we talk about Caterpillar, the non-directional sort of neutral sort of trade outlook, I feel much better with those trades as opposed to speculating on Netflix rising. Okay, 276 is the breakout entry, but generally what you want to look for, okay, this satisfies that of a continuation trade. All right, it looks like a continuation gap. All right, we've got a big gap. We haven't seen any back test. We're just moving to the upside in the direction of the open window. This looks like a continuation gap. According to that of gap theory, all right, really looking at about 3 or 4 different types of gaps if you include the island reversal in that setting. But in all reality, if you jump in at 276, your stop needs to be placed at 245. To me, that's about a $30 risk profile. That's too much for me, personally speaking, and I know for a fact it's too much for you. So when it comes to this trade, we have to work with the exponential moving averages moving forward. The first opportunity is going to be the rising 10, then it's going to be the 20. Expect this to slow at some point. Wait for the exponential moving averages to catch up to it, and it's going to be a continuation type of trade. Outside of that, it's going to be a bounce off the gap, which I'll update you on, or it's going to be the closure of the gap and then the gap continuation. Okay? That's the way Netflix is going to play out. In fact, as I look at this trade right now, in all confidence, in all foresight, in all honesty, I'm not even contemplating 276. I'm going to keep it there. It's a dashed line. I will never say, congratulations. Essentially, that was a relatively intelligent trade to place. If it's a dotted line and it continues, I wouldn't be messing around with Netflix. When you break it down into a risk reward profile, even if this runs to 300, okay, look at this, 276 to 300. Generally, the measured move is okay. Let me just break this down like this. Okay, when you have a gap, and all I want you to do is pay attention to the top here and the bottom here. when it comes to this rectangular box, I want you to only pay attention to the height of the box, which is what I'm drawing for you now, okay? Don't worry about the width of the box that I'm drawing now. It's only about the height of the green box. The height is recognized from this point here, which is where the gap began and the beginning of where that bullish move happened. And that's what gives us the height of this green box. So what I'm going to do, I'm just going to drag this over. It's not affecting that of the height. It is affecting that of the width, and the width is something that we do not care about. If I drag this up to the bottom of the gap, okay, right about here, this is that of a projection from the wave rotation of this move. Generally, when you get to that the same measured move as the continuation gap, that's where price will stop. So even if you look at this from 276, generally it'll run to about, what's that, about 290. But there is a psychological round number even at 300. So let's just say, give it the benefit of the doubt, above 276, you're looking at about $24 up to 300, which is here. And on the stop side of things, even if you were to adjust this with the rising 10, the 10 is actually below the open, the gap support. So, I mean, you're looking at a stop sort of placement at 244, somewhere between 244 and 250. Let's call it $25 of risk. To me, that is a 1-to-1. So if you, again, to break it down as per risk versus reward, I mean, we went through trades before with a 5-to-1 risk reward, if not a 6-to-1. So I think I've said enough when it comes to Netflix. It needs time to breathe. Just allow it, all right? Allow it enough time to breathe. Now, to sort of close with this week, and I really hope I haven't taken up 2 hours of your time, we have Tesla. Everything I've said about Tesla is becoming more crystal clear at this particular point. I was very concerned about a false breakout above 348, which was going to set us up very close to this high over here. That is exactly what happened. I was looking at this on Monday, and this was exceptionally bullish. However, we closed with a shooting star. First up wick. What happened? We gapped up on Tuesday and we traded down. All right, so we've got two signals, Monday and Tuesday, to say that, hey, hold your horses, this might be a false breakout. On Wednesday, we continued to the downside. Thursday, we continued to the downside. The only glimmer of hope for Tesla at this particular point is a lower wick on Friday, which is sort of coinciding with that of sort of a hammer at support. So again, in my personal opinion, this is looking more bearish than bullish. This is going back to, of course, all of the divergences which have been setting off since mid-2017 through to the late stages of 2017. This is coinciding with, of course, the breakdown of this macro support area and what may be, of course, that back test right now, which is currently underway. Another layer of bearish confirmation is if we move below both the 100 and the 200 simple moving averages, which are moving sideways at this particular point. All right, if we move below them, it's another added sort of confirmation that Tesla is probably moving into a considerable drop in share price. I mean, I'm looking at figures as low as 260 as the first areas of support. I also have, of course, the insurance policy, or really the entry, which is below this one long day Morobozu candlestick. So we still have a little bit of leeway. This red box here, if we break 314, it is going to be, I mean, you're going to see a massive, massive drop in the share price of Tesla. Having said that, now that we're obeying this resistance area, now that we've got this candlestick on Tuesday, this 2-day reversal pattern, I can sit here and say, well, if, of course, we don't break below 314, we've got the 361 bullish entry. What we're starting to do is graph the trade. We're working with price action. We're understanding the psychology. We're understanding the sentiment which has been forming for the majority of 2017, okay, with all of this support, resistance, turn support, turn resistance. And now we're really starting to establish potentially some macro lower highs, which is after, of course, some of these massive divergences in the MACD and price action, which have only come up to make relative highs. All right, so this is a massive trade under construction. I think it's going to be, or first of all, if it breaks 314, it's going to be one of the biggest drops in share prices for Tesla in recordable history. And it might be aided by a huge retracement, short-term retracement market reset, or like a reversion to the long-term sort of mean when it comes to recordable fundamentals of financial statistics, right? Reverting back to the long-term mean that we are a long way away from. And again, that is probably going to help Tesla if it closes below 314.97, if it's aided by the wind of the market itself, if it were to retrace or at least reverse from these upper levels. But at the same time, 361 up to 376, that's a gimme trade now that we've had this reversal. I'm not sure if it's going to happen. We could be setting up a back test of the support area, but at the same time, if I bring up the oscillators, have a look at these, they're all in sell. Stochastics is registering sell. RSI is trying to turn up off the 50. If we close below the 50 and break below this little swing high here, it's going to confirm that of a pullback, or at least potentially that of a bearish trend confirmation, much like the US dollar. And the MACD, ask yourself the question, is this turning up or, crossing down or crossing up? It's crossing down. And the histogram line is about to start accelerating away from the neutral point. So, this has got turning point written all over it. And I know we've had to wait for it, but I think once this trade confirms, it's going to be an exceptionally profitable trade. And it's going to be very interesting, of course, because it is, of course, a bearish trade and not that of a bullish trade that we've just been capitalizing on for, I guess, the majority of 2017 and into the beginning of 2018. So, essentially right now, that concludes us for this week's pro class. If you have any questions, please email me, success@pivotpoint-trading.com. I hope you found this analysis worthwhile, valuable, and you've learned a few things in terms of where we currently find ourselves historically as per some of those oscillating indicators. I think it's exceptionally important for you to understand this or to be notified by this. And I wish you all, of course, a very pleasant weekend. I look forward to bringing you some market updates during the week. The past week I have been in transit, so my apologies for that. But at the same time, I think we've really hit the nail on the head, so to speak, when it comes to the breakdown of this market as at the current juncture. So on that note, everyone, I am going to say farewell to you. Have a fantastic weekend, and I'll see you during the week for some more market updates. All the best. It's James signing off on behalf of Pivot Point Trading. Farewell.